You know that feeling when you hear about uh, rumblings in the banking system over in the U.S. and Europe?
hmm
It gives you this sense of, well, financial deja vu, doesn't it?
Yeah, it really does. Like, hang on, haven't we been here before?
Exactly.
Yeah,
That something big might be happening, sort of under the surface. One source we look at called it a silent tsunami.
it's a strong image. And that underlying worry, it's definitely out there. What we've seen lately, it really does echo some past instabilities.
So it's worth digging into.
For sure. We need to understand what's actually happening now.
Okay, so that's what this deep dive is all about. We'll dissect what's been going on in the U.S. and Europe, look at the pressure points,
And then contrast that.
right, contrast it with China's approach, specifically their deposit insurance system, see how they handle stability.
Sounds good. The goal being to give you, the listener, a clear picture of these events and, well, why it matters for your own financial security.
Yeah. We're using some expert analysis on the West and then this really informative piece explaining China's setup. Let's jump in.
Okay, so first off, these recent bank failures and near failures, they weren't just random, isolated things.
Right. Like SVB, Credit Suisse, Silvergate.
Exactly. You can see them as early warning signs, problems deeper down. One source had that analogy calling them the first cockroaches.
Okay, maybe not the nicest image, but it makes the point.
Yeah.
Suggests there's more hiding.
Potentially, yes.
Yeah.
So let's unpack Silicon Valley Bank first. That story is quite something. Massive growth meeting a sudden environmental shift.
The tech boom years, right? Deposits just exploded.
Tripled in just 3 years. Hit what, $189 billion?
Wow. And what did they do with all that cash?
Mostly bought long-term U.S. treasuries. About 75% of their assets went into them. Seemed safe at the time, government bonds.
Safe until interest rates move, I guess.
Precisely. That's the key. The Fed started hiking rates really fast, from basically 0 up to 5%.
And that hits the value of existing bonds.
Hard, especially long-term ones. SVB's holdings dropped in value by roughly 30%, based on our info. So a bond they held worth $100 might only sell for $70.
That's a huge hit to their balance sheet, even if it's just on paper initially.
It is. And then the tech sector cools, startups need their cash back, they start withdrawing.
And it happened fast.
Incredibly fast. $42 billion withdrawn in just 24 hours. A digital bank run.
$42 billion in a day.
Yeah. Left them suddenly short, like negative $1 billion in cash. The speed is just, well, staggering.
It really shows how fast things can unravel.
Look, it does. The digital age changes the dynamics completely. Confidence disappears. Money moves instantly. SVB couldn't sustain that outflow.
Okay, then there's Credit Suisse, a huge historic bank, 166 years old. But they seem to have problem after problem.
Yeah, a real cascade. A $5.4 billion loss on Chinese stocks in 21. Then another $5.5 billion hit from that hedge fund collapse in 22.
Archegos, wasn't it?
And then to top it off, admitting to unfixable accounting holes in 2023, not confidence-inspiring.
Not at all.
And when their biggest shareholder, the Saudi National Bank, said, no more capital.
Why was that?
They cited Credit Suisse's core capital ratio dipping below 4%. That's a key buffer against losses. That statement was like a trigger.
Spread the panic.
Wider panic, yes. And another vulnerability, a lot of their supposedly safe assets, about a third of $531 billion, were in mortgage-backed securities, also sensitive to rates.
Right. Not as safe as they sound sometimes. And Silvergate, the crypto casino's VIP lounge.
Yeah, vivid description. Their deposits surged 700% during the crypto mania.
Wow.
But when Bitcoin crashed from like 69K down to 16K and the Fed was hiking, their treasury holdings also lost value.
Double whammy.
And then the FTX collapse happened. That triggered the run on Silvergate. Deposits vanished in like 48 hours.
So 3 banks, different pressures, but all exposed underlying weaknesses.
Exactly. Different vulnerabilities, but amplified by market shifts and especially those interest rates.
Let's talk more about the Fed's role then. The rate hikes were steep.
It's very steep. Fed funds rate, 0% to 5%. 10-year Treasury yields, 0.5% to 4.2%. That sent shockwaves, especially for banks holding lots of those older, lower-yielding bonds.
Their assets were just eroding in value.
Right. One source mentioned a $600 billion figure for unrealized losses on long-term bonds held by U.S. banks across $860 billion in holdings.
$600 billion. That's hard to even grasp. The source said enough to buy 3 Teslas. Must mean the company, not the cars.
Yes, I think they meant the company. But seriously, that $600 billion figure represents a massive potential strain.
Even if they don't sell the bonds and realize the loss.
Even then, It weakens their capital cushion, makes them more vulnerable if depositors pull out money, and it might make them less willing to lend, which affects the whole economy.
And that connects to the great deposit exodus, people pulling money out.
Yeah. Why keep money in a savings account earning, say, 0.5% when money market funds are offering 4% or more?
Makes sense.
So $2.3 trillion flowed out of banks over about 6 months. Huge amount.
And the Fed had to step in.
Big time. Injecting liquidity, reportedly even more than during the 2008 crisis, just to stabilize things.
And regional banks got hit harder.
They did. Lost about 21% of their deposits in just 3 months. They're more reliant on local deposits, less diversified perhaps.
This really highlights how sensitive banking is now to rates and how fast money moves.
Absolutely. And the Fed's intervention, while necessary maybe in the short term, does raise questions about, long-term moral hazard. Does it encourage more risk later?
Good question. And what about the accounting? Sounded a bit murky.
Well, there's this practice where banks can classify assets as held to maturity.
Meaning they plan to keep them until they pay out.
Right. And if they do that, they can record them on their books at face value, the original value, even if the market value has plummeted because of rate hikes.
So it hides the problem, like the source's analogy about restaurants using old menus.
Exactly. It masks the true financial health. SVB, for instance, their treasuries were apparently overvalued by about 15% on their books compared to market price.
15%.
And the source estimated this kind of financial Photoshop, as they called it, could be hiding maybe $620 billion in losses across the whole industry.
$620 billion hidden. That sounds familiar. Like stuff we heard about before other crises.
It does echo some past accounting tricks or ambiguities, yeah. Creates a potentially misleading picture.
Okay, so if that's the situation now, what's the next worry? Sources pointed towards commercial real estate, CRE.
Yes, CRE is definitely flashing warning signs. Talk of ghost towns, high office vacancies, like 29% in San Francisco's financial district, 1 in 5 empty in Midtown Manhattan.
Those are stark numbers.
They are. And look at Blackstone defaulting on a $531 million Finnish property loan. That's seen as a potential canary in the coal mine for the much larger, like $1 trillion CRE market.
And who holds most of these loans?
Regional banks. That's the big concern. They hold something like 70% of CRE loans. So if that sector tanks, they are heavily exposed.
70%, that's a huge concentration.
It really is. Makes them very vulnerable.
And the interest rate hikes hit CRE too, presumably.
Massively. Think about loans taken out when rates were maybe 3%. Now they need refinancing maybe at 7%. Mortgage payments could double.
That could cause defaults.
Exactly. Unsustainable for some borrowers. Plus, we saw a huge drop, 68%, in financing through commercial mortgage-backed securities, CMBS.
That's where they bundle up lots of property loans.
Right. That market drying up means refinancing options are shrinking, and investors are clearly nervous about the sector.
Okay, so CRE is a big watch point. Now, one source drew this parallel to the 1970s stagflation. How does that fit?
Well, the core inflation rate, around 6.5% when the piece was written, mirrors the kind of persistent inflation seen back then, that wage price spiral in '79.
And the labor market is tight now, too.
Yeah, labor participation seems pretty much maxed out, around 63.4%. That makes it hard to cool down wage growth without causing unemployment to spike.
So persistent inflation, risk of stagnation. Sounds like the 70s on it.
It has similarities. And it puts the Fed, Chair Powell, in a really tough spot. Fight inflation hard and risk recession and more financial instability. Or ease off and let inflation run hot.
A real dilemma. Japan, meanwhile, is doing the opposite.
Pretty much. The Bank of Japan is keeping its cap on 10-year bond yields way down at 0.5%. Yield curve control.
Why?
One source called it strategic paralysis, but the logic seems to be avoiding rate hikes because Japan has enormous corporate debt, 128% of GDP.
Hiking rates could trigger defaults there.
Widespread defaults, potentially. So the new BOJ Governor Ueda saying 4% inflation is still mild. That sounds like someone prioritizing debt management over inflation fighting, a debtor's perspective.
Interesting contrast. So given all this mess in the U.S. and Europe, what's the advice for the ordinary investor?
Pretty sensible stuff, really. First, cash is king. Keep a good cushion, 6+ months of expenses, safe and accessible.
Good baseline.
Second, diversification. Spread investments across different things, gold, bonds, stocks, maybe even crypto, though carefully. But there's a warning. If the Fed has to reverse course and start printing money again, quantitative easing.
Like they did after 2008.
Yeah. Then we could see inflation surge again, maybe like the 1970s when commodities went up 300%. So watch out for that possibility with commodities.
Right. And any specific things to watch?
Keep an eye on those commercial real estate vacancy rates we talked about, and also deposit flows at smaller banks. They can be early indicators of stress.
Got it. And that final analogy, the cockroaches in the kitchen.
Yeah, the idea is don't just focus on which bank might fail. Look at the whole system. Guard your own resources because the whole situation is like a tightrope walk. Systemic risk is the real game here.
Definitely feels uncertain. Okay, let's pivot now. Let's look at China's banking system and this deposit insurance angle.
Right, a very useful comparison. Our source there starts with a specific incident, Jiangsu Rural Commercial Bank.
What happened?
Rumors started flying that it might fail, caused a bit of a bank run, people lining up to get cash. But the bank reacted fast. Shipped in physical cash to branches, piled it up visibly. That calmed people down.
Visual reassurance.
Exactly. And the crucial piece, since 2015, China has deposit insurance. Deposits up to 500,000 yuan are protected. That knowledge helps prevent panic.
Okay, so that brings us to deposit insurance itself. The source called it a vaccination for the financial system. Explain that.
Well, think about why bank runs are so bad. It's fear-driven, right? You hear a rumor your bank might be in trouble. What do?
Run to get my money out, just in case.
Exactly, everyone thinks that way. This mass withdrawal drains the bank's ready cash. Then, to pay depositors, the bank has to sell assets quickly, maybe at fire sale prices, taking losses.
Which makes them weaker.
Right, it becomes a self-fulfilling prophecy. Even a healthy bank can be pushed into failure by a panic-driven run.
And it doesn't stop there, does it? If one bank fails.
It can spread. Businesses using that bank can't make payroll, people lose jobs, confidence in other banks starts to wobble, panic becomes contagious, like a plague, as the source puts it.
A domino effect.
Precisely. That's the systemic risk. Deposit insurance breaks that cycle. If you know your money is safe up to a certain limit, even if the bank fails.
You don't need to rush to the door at the first rumor.
Exactly. It removes the primary incentive for a bank run.
And the U.S. actually pioneered this. After the Great Depression?
Yes. Fascinating history. During the Depression, over a third of U.S. banks failed. People lost everything. An absolute disaster.
Unimaginable.
So, in 1933, the Glass-Steagall Act created the FDIC, the Federal Deposit Insurance Corporation. Mandated insurance for member banks guaranteed depositors would get paid back if their bank had problems.
And that made a huge difference.
Monumental. Milton Friedman apparently called it the most important U.S. monetary policy move since 1933. It fundamentally changed banking psychology, reduced runs dramatically.
Okay, so back to China. Before 2015, they didn't have this formal system.
Not explicitly, no, but it wasn't seen as a huge issue for a long time because the banking system was dominated by massive state-owned banks.
Everyone assumed the government would back them up anyway.
Pretty much. An implicit guarantee from the state, national credit standing behind them.
But things changed after 2005.
Yeah, the landscape shifted. China liberalized its banking sector more. Lots of new, smaller banks popped up, joint stock banks, city commercial banks, rural commercial banks.
How many are we talking?
Over 4,000 banks in total now, apparently. And most are these smaller local ones. They don't have the same resilience or assumed state backing as the giants.
So more banks, some potentially weaker, increase the need for formal protection.
That's a big part of it. Plus other factors. Interest rates were liberalized after 2013, meaning banks had to compete more for deposits, pushing up their funding costs.
More pressure on margins.
And then you had the rise of things like Yuguobao, Alibaba's money market fund. Super popular, drew huge amounts of money out of traditional bank deposits.
Ah, so competition from outside the traditional banking sector too.
Right. All this put extra pressure, especially on those small and medium-sized local banks. Rising costs, deposits flowing out. They became more vulnerable.
And there were actual incidents, besides the Jiangsu one.
Yes, the source mentions runs at a branch of China CITIC Bank and Shandong Lincheng Bank, too. Called them alarm bells. Showed that poor management or high bad debts at smaller banks could trigger runs.
And the internet makes news spread faster.
Instantly. So even a local problem could potentially cause wider systemic jitters if people weren't reassured.
Which all led up to May 1st, 2015, the launch of the formal system.
Correct. All deposit-taking institutions now have to insure deposits, and that limit is 500,000 yuan per depositor per bank.
How much coverage does that provide overall?
It's estimated to fully cover about 99.7% of all deposit accounts in China.
Wow, almost everyone.
Yes.
Yeah.
It effectively safeguards the savings of the vast majority of ordinary people, which is key to preventing widespread panic.
So, just to recap the China part, Deposit insurance protects depositors if a bank fails, which stops them panicking and running on the bank, which in turn helps keep the whole financial system stable.
That's the core idea, the vaccination preventing the spread of financial panic.
And the conclusion is that, with this system in place, people's regular bank deposits in China are now basically guaranteed safe.
That's the takeaway from the source, yes. A significant step for financial security and stability there.
Okay. So bring this all together then. We've seen the vulnerabilities being exposed in the US and Europe, the rate shocks, the deposit shifts, the CRE worries.
And contrasted that with China's more preventative approach through establishing widespread deposit insurance.
It definitely gives you a broader perspective on global financial stability or the lack of it and the different tools being used.
Absolutely. Seeing these different scenarios helps us understand the challenges and the risks that are still out there.
Definitely. Now, on that note, the source on China finished with an interesting question for you, the listener, to chew on.
Oh, yeah.
It mentioned those baby-type bank wealth management products in China, sort of like money market funds linked to banks. Are those covered by deposit insurance?
Good question. They're not exactly standard deposits.
Right. And following on from that, which would you prefer for your savings? A standard fixed-term deposit that is insured, or one of these potentially higher return but maybe uninsured baby products?
That's a practical trade-off many people face. Risk versus reward and understanding what's actually protected. Definitely food for thought.
It really highlights how financial products are evolving, and you need to know what protections apply or don't apply.
Couldn't agree more. Staying informed, understanding the mechanics behind it all, it's crucial in today's financial world.
Well said. Thanks everyone for joining us for this deep dive. And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.